Greetings, market rebels. Welcome to this week's sector situation. I'm Wayne. My partner Ryan is somewhere out there on his way back, I guess, from the Miami event that Market Rebellion just held there. Hopefully everything went well down there. It sounds like it was going well. And he's going to be working on Market Outlook, which will come out later today. We pretty much guarantee that, other than tech issues, but I know Ryan will be working on it. Anyway, it's about 12:30 Eastern time here on Sunday, December 11th. Let's get into the sectors. We'll flash a couple of quick necessities. The disclaimer, the old trusty disclaimer there, and also our trusty intellectual property rights notice. And with that, I have to switch the share from one screen to another. So let's get this minimized. Let's get the right screen shared, and that would be screen number 4. Screen number 4. Be sure that's right. All right, share. Yeah, so just starting sector situation. It's doing that. There it goes. Okay, so just starting sector situation now with the SPYs. Just a quick recap. I think last week, my memory is we thought that the market ended the prior week much like it had the week before. So we were thinking, pull back a little bit, come back maybe towards the 20, see if it holds there, and blue didn't. And then 100 was where we were saying, like, we're not going to be really giving the bulls the benefit of the doubt if it falls below there. So we got a really quick swoon, and a larger swoon than I expected in the first couple of days of the week. But we did get down towards there, but they didn't knock it out. They were able to hold for 3 to 4 straight sessions, depending on how close you want to give them on their little Friday maneuvers. But that was late selling. We were positive, we were negative. In the end, it ended ugly. So I don't know how much of that was OPEX. I just don't know. It's very hard to say if we should read into that, but you have to just say, if you want to go just completely objective, that things look concerning right now. And to me, and I think it's a lot like what we've seen. It's almost too easy, right? When we've fallen below support, and I'll highlight the support line in blue, falling below support when we've been in one of these corrective rallies, aka bull market rallies inside of what's been a bear market. When things finally start cracking, right? It's been good to trade it that way. That's been the long and strong movement rather than the short and sharp movement. So there have been some great rallies, though, right? There was the early summer rally that got started. You can see there's money to be made if you're willing to go along with both sides and just be an equal opportunity trader. And right now, though, I've got to say that I think that things ended ugly. I mentioned that to Dirk on Cocktail Hour. That's where I want to pick things up on sector situation, because where's my sector stuff? There it is, I think. There it is. Yeah. So here's our 12 that we take a look at to start out most weeks. And you can see that our concern there with XLE saying, hey, something's got to give one way or the other. We were looking at, where's that at? We were looking at here. And so this is, let me make sure we've got the right stuff here. So that's crude oil there in red. Let me switch the main symbol over to XLE. And you can see that once it finally comes up, and there it is. This is what I was trying to flash, that Ryan had to flash a picture of. But we were thinking, hey, something's got to give here. Either crude is too cheap, right, or stocks are just too high, because the correlation usually is stronger. Not instantaneous, not always, but pretty big, divergence or discrepancy. And it seems like it started, the stocks finally started to catch down to what's been happening in crude. So I guess, right, all the weeks we've been monitoring that maybe paid off. I added this diamond this week to it. But bottom line is, maybe that finally paid off for us to keep an eye on that, at least for starters, right? Who knows? But at least we didn't get caught off guard by what was happening there, at the very least. So that's good. But that to me is also a sign that, again, more of a macro thing, but that to me is, and I don't know oil market particulars right now, and it's its own thing in my mind. You've got to be really dialed in if you're in energy space and oil, but to what's happening, industry stuff, to developments, news, releases, politics, what's happening in foreign currencies. There's a lot of stuff that you can look at, but this just doesn't look good right now. I mean, neither one looks good. So we'd have to find a level. Maybe we're near one now, but they've got to find a level and try to. Anyone that wants to be a bull, excuse me, has got to find a level they want to step in at. Otherwise, right, if this just keeps going, it's just not good for this. It's not good for really economic signposts in terms of, hey, what's going on out there? Not great, right? If that's not looking good, and we talked about lumber, we talked about copper. If these things are not looking good, then that's just simply not good, right? Typically, right, for the economy, that those some of these critical things just do not look good. So I'm very concerned now, again, quickly, right, being willing to shift on the fly. Let's get back to our sectors, though, to get a better look at them. I think it's those right there. So, excuse me, I put lines under everything again to try to give us a little bit more perspective. They're not perfectly drawn, as you can see, but you get the idea here. That suggests vulnerability possibly there in tech again. To me, you're right on basically support, or right above support, I should say. Starting to crack support in communications. You'd have to go more for and I'll make it a little bit larger, but you have to go more for the flat line. Maybe the flat line's holding us right now. But if that cracks, right, you maybe are on your way to filling this gap in a retest. And this is where I think it all becomes about Powell. And that's really more than likely going to be the determinant of the weekly outcome and possibly the whole balance of the year. So XLF, we were fortunate. We've been fortunate in a lot of sectors, in UOA. The UOA team's been doing a great job, and we were able to get things on both up and down. And that's been really good in some of these sectors. I think we had BAC, may have even had XLF, a couple other names, maybe Morgan Stanley. But we've tried to get involved on the way up and on the way down. So that's been good to find paper there, but that's cracking, right? That is cracking. The transports have cracked. Right? We had FDX this week as a name because we liked a lot of other things about it. We liked what was happening in UPS. We also liked, the fact that transports were cracking, and that to me is a big deal. Notice, right, XLV healthcare is still hanging in there, right, just right off the highs, maybe a double top, who knows, mini double top, but hasn't fully cracked support yet. It's right there. So that staples very similar, right? We've been pointing this out. And then, of course, over here, XLU, also defensive, very similar. They've all been hanging in there. Shockingly to me, XLB, basic materials, and industrials have been great performers, but you can see now that there's your flat line again, right? The flat line is really all that's left. I think you're at your risk of losing that uptrend. And if you crack that, then you've got some gaps that you left way back here, right? I know it's only 10 points, but visually it's a big drop. XLB, similar situation with gaps. Hasn't fully cracked in my mind, though. So XLB, I think, hanging in there a little bit better. Technically, I think this very much looks like it's at risk, XLI. So it is what it is there. Utilities, we already talked about how those and healthcare and staples have all hung in there, but they're also right on support, right? They're on support now. So discretionary already gave it up. It already started retreating, probably on a flat line or close to one right now. That's all that's left between it and maybe challenging the next lower level down near 134 and change. But then beyond that, you would drop all the way and maybe have a retest of the low. Real estate, to me, again, remains a little baffling. It did crack below support last week. I'll enlarge that a little bit. I should have probably enlarged all these, but that did crack. You could see they tried to test the resistance line since we're below it, which was a support line. Couldn't get back above for 3 sessions there, whatever you want to call it. We'll see what happens. I'll say, okay, if it gets back above there, then that's impressive. But otherwise, right, this is maybe the start of failing below to retake what could convert to support. And if not, there you can see there's a flat line here too. So a lot of these, a little bit more weakness. This is why I've become concerned with the whole picture that you just get a little more weakness in here, and these things are going to crack important. A lot of them will either crack a rising support line or a flat line, and some of them already have. And if you watch macro measure, you'll see that as of right now, there's a lot of the biggest name stocks that most of them look concerning. But again, we all know this is why it's tough to do these videos and give something super definitive on a Fed week, right? It probably all depends on what Jerome Powell and company decide to roll out. I couldn't show this on macro measure, but I just wanted to note that the concern that I'm picking up is also in the market in terms of some of these breadth measures I like to take a glance at. Don't want to go too much into those. It's more of a macro measure thing, but they're just rolling over, right? Showing you that people are, I think, bailing a little bit on the rally right as it got to resistance, which has been the trade to really make all year long, as has the catching the turn on some of these bull rallies have been very strong and sharp too, which has also been good. So it's been a good year for trading if you're open to both directions. I think. I mean, it hasn't been a gangbusters year in terms of what we've done over the years with Market Rebellion and in the services. No, it hasn't. When you get the super strong type stuff that we got after the COVID response, that was, I think, the best stuff I've seen. Probably 2020 was the best stuff that I've seen, and into 21 that I've seen since really 1999, 2000, which was a whole nother level of madness. But that post-COVID rally was a sight to behold. We kept seeing such incredible bullish UOA, kept putting it in for folks into the services, and it kept working. It was just a remarkable time, and it worked so well that it was astounding, in terms of returns. But let's take a look at some of the other sectors we look at in sector situation. Here's your semis, bigger view. Let me try to give us a little bit more here. And they're hanging in there. NVIDIA's hanging in there. That's one of the stocks that's a large cap stock that's hanging in there pretty well. So there's a little bit of hope there. The 200's right there in purple, but this has clearly been a choppy consolidation after a very strong run. Remember, these are, I think, an important sector. I think you could try to trade a breakout above the 200 there in purple, especially right post Powell if things are working out. And certainly, I think you see there's a flat line, and you get below, let's call it 214-ish, which is just about the 150-day moving average there in Rust. You get below there, you do have some support coming in from the 100, but that's probably the real right? Somewhere near there. Maybe the 100 is probably worth noting. That could be it as well, but that's a problem. Although, look, it's got the kind of cup and handily thing going on. So the reason I mentioned that, aside from the obvious, is just that it's usually good trading when you've got a pattern that's near maturity. And that pattern should either fire, right, in the way the textbooks suggest that it should, or it fails to fire, and a lot of people that bought maybe thinking there was a breakout get trapped. They shake them out, and you can have a very quick sell-off. So there's a lot of that going on. I can't get into the particulars there, but that's why I like to see patterns that are maturing or near maturity in my book, because that suggests that we're on the cusp of some volatility, which of course movement is what most of the services are keyed off of. Some, of course, like Iron Condor service, TBO, we prefer no movement, but that's not realistic in this modern market anyway. XHB, one that, again, probably can be a head scratcher at times, given what we all know about the housing market situation. I think it's pretty darn dismal, the real estate situation. And this is really just the start of it, seemingly, but it's hanging in there. I've got some ideas on in there in UOA Pro that we put on to prep for this. I'm really not that interested in being a bull in there. It could work out. I mean, if I saw a reason to be, I would be happy to add it, just because trading is trading. But this is one I probably would have to admit that I'd have a harder time adding a bull in this space than I would in other spaces, just because the fact that I think things continue to worsen and we remain this far off the lows of the year, which we're actually way back here in June. Kind of blows my mind in a way, but it is what it is. You have to be objective about the charts and trade what's in front of you, which is really the mantra of the Rebel Pit, especially. But yeah, I mean, what do you make out of that? Just consolidating after a big push. Maybe it likes the fact that rates look vulnerable to go lower soon. Maybe the Fed tops out here and then we start going lower, and they're anticipating that. I just don't think with the run that rates had and the prices that housing is demanding still in many places, and the employment situation and the inflation situation, I don't think anything fires up right away. But for sure, I'm definitely not a fundamental expert in all that kind of stuff, so I don't want to go too far afield. Here's gold and silver. Been seeing better paper in here. We've been giving that a little bit more of the benefit of the doubt. Few trade ideas, minimal in there. It looks better, but this again, a notoriously squirrely space to trade in, can be very, very hard at times. There's so many really serious takedowns by the powers that be at times. It can be very, very difficult. I like to use it more as a hedge. Sure, I do occasionally do trade it. Used to trade it a lot more, but it seems like you're better off being a position trader as opposed to a swing trader. What I mean by that is it probably fits kind of some of the stuff that AJ does well, the longer term, middle, intermediate to longer term stuff. Because if you get the kind of general idea right on the technicals, which I think has been pretty good in terms of bullish stuff lately, which it definitely started showing us stuff a few months ago. If you get that right, and then you've got a fundamental driver of that you can cite that you think is legitimate, it takes a while for these things to play out. They play out way slower than at least I ever expected, but eventually they do. So that's kind of good for that longer term orientation. It can be a bear to trade day to day. It really can be all the stuff that happens in those markets. Let me try to see what else can we look at. Lumber, maybe, and we'll look at copper. We've been taking a look at those. Copper hanging in there a little bit better. So we'll give it the benefit of the doubt, but still hasn't broken out yet. You've got to use those highs. That would certainly be something if that were to happen. And then let's take a look at LB. Here we go is it going to give me the chart? Let's see. Doesn't like that one. I think I picked the wrong one. I always forget which one they like here. Yeah, doesn't like that one. Okay, let's try something else. Not that. Let's try LB, not S, LB. Let's try January. This will take for now. Yep. And that, again, nothing special, right? It's below every SMA, almost all of which are downsloping. I can say I don't have them all up there for whatever reason, or they're hidden behind each other. But you get the idea. There's nothing special happening there. So did see some, just so I note this, there was some paper that popped up. Let's take a look real XBI. So come on, there's biotech. We'll take a look at this one. Flatlined. This thing's, every time we look at it, which is occasionally, we pretty much have the same story. This is probably a range trader's dream to be in this bad boy, but that's really what do you say? I'm about to lose the SMA and then probably fall below the 150 and then maybe plumb a little bit lower and then try to go back up again. But yeah, I don't see anything there. We have seen a little bit of paper pick up in there, so it is what it is. I just wanted to mention that. Let's see. Oh yeah, so we did see some larger paper too as the week ended on things like HYG, IYR. They've been making a little bit of a comeback in terms of UA. So anyone that's interested in IYR, HYG, LQD, they've all been perking up, I think, a little bit. So maybe after Powell, there's going to be a move or a trade in there. So just ones to keep an eye on. Don't want to go through those too much, but drag this out. But to go back to our view of just the sectors, which should be here. So yeah, I think the end note here and summary is a lot of things have fallen below support. The defensive sectors are still hanging in there better than other ones in my book. Important things like the transports, the financials, the energy space are all rolling over or looking vulnerable. Tech is hanging in there along with the semis. But I'm definitely more concerned with the way things have shaped up. I was willing to give the bulls the benefit of the doubt. They lost the 20 in the SPY very quickly last week. They lost they got all the way to the 100 on Tuesday, I believe. And ever since then, I've been more concerned. And I think the way the week ended is more concerning. So what that kind of shows up in these sectors, though, a lot of things just got worse or started to get worse. And energy, I think, was a big one. And that flat line we talked about in there, that broke and we went lower. And just remember, we're talking about that in other sectors right now, that the flat line after the break of the rising support line, the break of the flat line could be what lets these things go. And so they're on the cusp of, I think, falling right now. Maybe there'll be a little weakness in front of Powell. I don't know. But unfortunately, right, the truth of the matter is, just like with macro measure, we can sit here and talk about this stuff all day long, but the Powell reaction is really what matters. It's just that I think things are set up right now to fall further, which goes against the seasonality that we've looked at a lot of the year. And if you don't watch the macro measure video, I've been trying to pull this up during some of the weeks, some of the videos, just to show that in midterms, under all these different conditions, pretty much you have a swoon in, as we just sort of did, right, leading into the middle of December, but then they do the old jam job towards the end of the year. And so if Powell gives them something to hang their hat on, that's probably what they're going to do. On the flip side, if Powell is just going to now disappoint them, I think the Fed the Fed meetings were rough on the market in the earlier part of the year. The last few times the gang has used that to jam things. That's the trend. I'll give them that. But again, Powell may not like the fact that we were recently only down just over 6% in the Dow Jones on the year. So now last week's weakness, of course, brought that down. But bottom line is, things, if there were no, I'll put it this way too, I did this in macro measure. In my mind, things, the bulls have their work cut out for them. If there were no FMOC Powell routine coming up this week, I would be ready for more of a breakdown. And I think that, as we always say, selling begets selling. So you get more of a technical breakdown if there's just a little bit more weakness, if they don't hold them pretty darn close to where they are. But of course, there's the Powell thing that could really upset the apple cart. And there's just no way to know for sure, of course, in front of that. So I think that's probably a good place to wrap it. I think you could trade in front of Powell, but I would always encourage folks to get prudent in front of Powell. Even if you have strong convictions that we're going down or we're rallying, that's fine. Leave things on through Powell, but maybe that's where going from 70, 80 delta in the monies that you've been riding for a while, maybe that's where you make the switch to 40, 45 delta or 40, 35 delta options, so that, yeah, you're still in the trade the way you want to be, but you've got a lot less at risk, just even though you have high conviction. Just because, right, if you're right and there's going to be this really strong move after the Fed, and you've got an option that's good for a couple of weeks out, you should still be fine with something that's 40, 45, or even 35, 40 if there's going to be a really powerful move. You should still be able to do fairly well with that, especially, right, given that the VIX is not elevated and anything you've been buying recently in most stocks would be somewhat reasonable relative to, in IV terms, relative to other points during the year. So I'll end on that note. I want to thank everyone for tuning in. I hope something I've shared with you this week helps you either this week or next week. And remember to stay nimble out there, and I'll be in touch through webinars, updates, so on and so forth. Thank you.